So finally, let me come to my conclusion and recommendations. I must just reiterate that high inflation and interest rates have persisted for far too long in Ghana. And these have had devastating effects on growth and employment. Now, monetary policy, unfortunately, has been largely ineffective in addressing this problem precisely because it is not tailored to dealing with the fundamental causes. Now, we think that a new approach is called for to ensure that monetary policy is more fit for purpose. Now, one, as we have said, Ghana has a history of inflation persistence. This is the result of enduring supply or cost and demand factors, both. Because IT is largely an inflation target, a demand management tool, it is not fit for dealing with the entrenched supply or cost undercurrents of inflation. In particular, food price, fuel price, and exchange rate volatilities have been persistent drivers of inflation, but are not amenable to IT. Further, IT is equally inhibited in dealing with demand pressures because they are driven by an enduring fiscal deficit bias. Now, a more comprehensive approach is needed to stem inflation on a durable basis. In particular, the Bank of Ghana should engage governments and the relevant agencies to stem volatilities in food prices, fuel prices, and the exchange rates. A permanent solution should also be found for the persistent fiscal deficit bias through effective revenue enhancing and expenditure containment measures. The revenue side, there are several loopholes to the tax system should be plugged. And then on the expenditure side, rationalization and rebalancing are called for. Now, these are revenue loopholes that we've been talking about forever. If they were effectively plugged, even e-levy will not be necessary. Now, lending rates have been out of control in Ghana for years. This is the result of multiplicity of factors, including persistent inflation, high cost of monetary policy, banks' inefficiencies and high operational costs, high borrower risk, government incessant borrowing, and high bank taxes. Now, the persistence of high lending rates is concerning because it has negative effects on investment growth and employment. And given the multiplicity of causes, monetary policy alone cannot resolve it. The resolution must come from all the relevant parties, that we've mentioned. Now, Bank of Ghana, on its part, must ensure a more effective way of controlling inflation so that monetary policy itself does not fuel lending rates. Bank of Ghana must strengthen safety nets for borrowers, including through the identification and credit, worthiness schemes. Bank of Ghana must ensure strong oversight of the banking industry to engender efficiency and high standard of operation, and to prevent collusive and customer capture practices that tend to sustain high lending rates and other financial charges. Banks, on the other hand, must improve their operational efficiency and reduce their costs to a minimum, including through modernization of their processes and systems, and through strategic company focus and foresight planning, so that these do not feed into lending rates. Meanwhile, government must restrain its borrowing to reduce pressure on lending rates by addressing the budget deficit bias. Government must also ensure that banks' taxes are not out of proportion or inordinate, so that they do not overly overburden banks and therefore fuel lending rates. Now, finally, the Monetary Policy Committee, I think, faces a difficult decision at this juncture. They are meeting from now till Friday. Now, in principle, the Monetary Policy bases its decision to adjust the policy rate on how the committee perceives to the balance of risk between inflation and growth. That's how they come by their decision. Now, on the one hand, inflation has risen consistently and sharply in the past 7 months, as we showed you, taking it well beyond the MPC target. The MPC target is 8 plus or minus 2. Inflation is now at 12.6, so it's well beyond that. And then the risk to the outlook, if you look forward, food and fuel prices are likely to remain high. Meanwhile, the exchange rate faces uncertainty or upward pressure. Then on the other hand, there's evidence of a fledgling economic recovery, although the outlook seems crowded by an uncertain pandemic. Now, my judgment is that if I'm looking at the balance of risk between inflation and growth, my judgment is that the inflation risk outweighs the growth risk at this time. On that score, if you are looking at just that, you will say that the policy rate should be adjusted upwards to deal with the inflation. Okay. However, recalling that the policy rate, the Monetary Policy Committee increased the policy rate by 100 basis points just 2 months ago at their last meeting. Now the likelihood of another follow-up increase may be low, because normally when they hike the policy, they want to see it work itself through the system, and for a while. So in the circumstance, my expectation is that the Monetary Policy Committee will try and play it safe by holding the policy rate at its current level of 14.5%. Now, this will allow the committee to buy a little bit of time until its next meeting in March, when a few more inflation readings would have come out and made the situation clearer. But the key messages are that now IEA, we are saying that monetary policy has not been able to deliver its key objectives of low and stable prices and interest rates. Now, we are saying that a comprehensive approach is required to control inflation. To ensure low interest rates, we need the joint efforts of Bank of Ghana, banks, and government. No single entity can do it alone. And then we are predicting that the Monetary Policy Committee will maintain the policy rate at 14.5%. I'm looking forward to the monetary policy decision, the meeting and the decision.